Hey everybody, I'm John VanDuzer, CPA and partner with James Moore and Company, and I'm here with Kevin Golden, one of our tax directors. And today we're going to be talking about tax planning for real estate operations. So thank you, Kevin, for joining me.
I'm glad to be here. Thanks, John.
Yeah, so Kevin, we're both on the real estate team, and so we deal with tax returns and tax planning for real estate companies, on a daily basis. And so you and I thought we'd get together and talk about some of the things we see over and over and over again, and really kind of spell things out for everybody. So why don't we jump right in? I think one of the biggest areas that we see when talking about rentals is whether a certain item is classified as a capital item. That means you have to capitalize it and depreciate it over time, or an expense like a repair for tax purposes. And so a few years ago, there were these things called the tangible property regs that really clarified things. So why don't you walk us through kind of that thought process on whether something is a capital item or an expense?
Sure. Thanks, John. Yeah, I think a lot of our clients in that space really focus too much solely just on cost. There's a lot more to really weigh and think about, right? With those regulations that you mentioned that came out, also what came out were what were known as RABI rules, right? This is RABI, restoration, adaptation, betterment, and improvement, right? And it basically says that if the expenditure you're making improves a property through a restoration, restoring a piece of property, adapting it, taking a piece of property, using it for something different than what it was originally intended, or making a betterment, making it better than what it originally was, then it should be capitalized as an improvement. Everything else, right, should not be. So an example is like painting, right? For example,
Right.
that painting's needed all the time, right? Well, that's not really restoring, it's not adapting or making that better. We're just simply painting over after one tenant has left, making it, making those walls better and for the next tenant. So that's just a normal routine maintenance item as a repair. It does not fall underneath those rabbi rules. But anytime that you're making some sort of expenditure that you're wondering, hey, should this be capitalized? Is it an improvement? Just go through those rules: restoration, adaptation, or a betterment. And if so, it probably should be capitalized as an improvement. If not, you can expense it as a repair.
Right. So you take painting, for instance, and we talked about this, it can be tens of thousands of dollars, and the cost doesn't matter. It really is, does it actually restore, adapt, or better the property? And if the answer is no, then it's an expense. Betterments get kind of tricky when, in the example there is taking, a certain unit of property and increasing the capacity, right? So you have an AC that's a certain rating and you change it out with an AC that's a different rating. Well, then you have a betterment, and so that will end up not qualifying as a repair, even if it would if you replaced exactly the same thing. Under those rabbi rules, and you're looking at the unit of property, there is this 30 to 40% rule where if you replace less than 30 or 40% of a certain component, then that doesn't qualify as that restoration, adaptation, or betterment, because you're looking at the property as a whole. So an example is like the roof. If you replace 10% of a roof, you look at the roof as a whole and you're saying, okay, the roof as a whole wasn't restored, adapted, or bettered, even though a portion of it ended up being replaced. And so that also gives you an opportunity for an expense. So when those items do meet an expense or a capital item, the next thing we look at is a capitalization threshold. So why don't you tell us kind of what the rules are around that capitalization threshold?
Definitely. And this is another great gauge to say, hey, is this something I should even be worried about, right? So there is a de minimis that the IRS has changed over the years several times, but finally landed on about $2,500, right? And this is just saying for anyone who doesn't have any sort of formal financials or anything like that, that hey, if the expenditure is under $2,500, we're not going to worry about it. The intent there was to say all this small nitpicky costs, you can expense those, right? Even if it may technically fall underneath one of those rules, then you can, underneath that 2,500, you can expense that. Anything above that does not automatically mean it should be capitalized, but it should be at least be analyzed further. And again, all these rules, what they're getting at is it's important to understand when we can expense these, because again, that's going to not only lower your income on that, but lower your taxes upon that, right? So in other words, you can put more expenses now, deduct more things now. It's going to put more money back in your pocket now, rather than some of these capitalizing some of these items are going to really spread that out over the life, over much longer time period where you receive that benefit. But really, that kind of de minimis is about $2,500 that you should be looking at.
Right. So what if I own an apartment complex and I buy 100 refrigerators at $1,000 a piece, and I spend $100,000?
Yeah, no, that's a very good question, right? So the overall expenditure is obviously way over 2,500, but again, we're looking at each unit, right? So in that example, right, that we're able to take all those units and say, hey, they're $1,000 each underneath that, then we can still expense those underneath that de minimis threshold. So again,
Right.
It's not just looking at your dollar amount and saying, hey, this total transaction. It's looking deeper. It's looking a little bit more into that and saying, hey, how much was each of those units, not just a total expenditure.
Right. So it's per item. It's not a per invoice
Absolutely.
threshold. So you can have very significant, and we've seen it, where we've seen, 6 figures in purchases, but if it's appliances or equipment or, that sort of thing, and it's all under that $2,500 limit, then you can expense that, under that capitalization de minimis rule. So that can be a very significant savings. The other thing to balance on that capitalization threshold is sometimes you want to make sure that if you have a lot of these purchases, that it's clear what your true NOI, your net operating income is, right? So we take and we buy 100 refrigerators, and for tax purposes, we're able to expense those because they're under $2,500 each. Well, your NOI just took a $100,000 hit on that purchase, and so that may make your financials look worse than they actually are. So we suggest segregating those type of costs so it's very clear that capital items under $2,500 or some descriptor, so that way it's clear to the banks, it's clear to potential investors or purchasers and everybody that this is really a tax move and not a true indicator of what the the value of the property is.
And that's a great point, that all of these that we're talking about, these are tax answers, but they're not the only answers. As we suggest with everything else, look at your whole big picture, right? Have a conversation about it, right? There's a lot of great benefits, but again, we don't want to just look at just our tax answers. Look at overall answers and see what works best for you in your situation. But yes, definitely, I agree. A lot goes into presentation, good record keeping, and so forth to make sure you can segregate those types of costs out from just normal operating expenses.
Yeah. So another thing that we look at quite frequently in this space is partial asset dispositions, and accountants like to shorten everything, so we call them PADs. But so Kevin, why don't you tell us about PADs?
Right. So underneath the old rules, right, whenever we capitalize an asset, right, then we simply depreciate that until we either get rid of that asset or we've depreciated it fully, right? And that's how we obtain the deduction. Underneath the new tangible regs several years ago, right? One item that came out was, hey, it's better explained through an example, a roof, for example. All right, well, we replace a roof. It's not underneath that 30 to 40% threshold we mentioned earlier. It's a lot more than that. So we must capitalize it, right? Well, underneath the old methods, you had to depreciate the old roof and the new roof, right? Because roofs take a long time to depreciate. They have a very long life for depreciation. So you found yourself in a situation where you're depreciating an old roof and the new roof you just paid for, right? So it doesn't provide a whole lot of benefit. Well, underneath the new rules, they said that would qualify as a partial asset disposition, right? Saying, hey, we know you purchased the new roof, you put it on, well, guess what? You can go ahead and write off that old roof. Again, it's a great reason to make sure that your books and your records have all these types of costs segregated out, because now when we replace that new roof, if we replace maybe your new HVAC, or if you're a commercial renter, maybe you have several of those units and replace a material amount of those, then now you can get rid of the old costs, the old roof, the old HVACs, things like that. That again, now that's another deduction to you, right? Any cost on that old roof, on the old HVAC that you have not recognized through depreciation already, you can write it all off now. So again, in the year that you're having to come out of a lot of money to repair, or excuse me, to maybe put on a new roof or new HVAC, you're able to at least recoup some of that by disposing of the old asset, what's called a partial asset disposition.
Yeah. So what if I bought a building 10 years ago and I just said, okay, I bought a building for $1 million and there's building asset on my depreciation schedule. And so now I'm replacing a roof and it cost me $100,000. What do I do about that?
Yeah, no, that's a great question. So what we're able to do there is we're able to look at the historical costs of the building, right? And basically we're able to back into what that old asset would have been, right? Had we broken that out, right? And we're able to come up with, okay, here's what of that old building, or that maybe that building that we purchased a long time ago before these regulations were in place, what portion of that would have been the building using the new purchase of the new roof as an example, right?
So
And then
the IRS publishes the inflation factors, right? So they say a roof today costs, 80% 10 years ago, so
right,
you can take 80% of your current cost and that's what you write off from your original asset, with the associated depreciation and everything. So it
right.
allows you to continue to make those dispositions, even if your records are less than perfect as far as what the exact component, or any given component of a building are, which I think is a really favorable rule.
Definitely. And either way, at the end of the day, you're having to now capitalize something like a major component, like HVAC, like a roof, or anything like that underneath those rules.
Mhm.
There's probably some sort of partial asset disposition that you can write off some older assets to go ahead and help offset and deduct those items today.
Yeah, which is a good benefit. And so a hot topic, especially like in the retail and office sector, is qualified improvement property. So why don't you walk us through kind of what that is and why it's important?
Definitely. And like you mentioned, we're accountants, so we make everything an acronym. So QIP, or Qualified Improvement Property, you'll hear it called. So this is basically improvements made to the interior of a building, right? I mean, a lot of times a tenant will go in, right? Then they'll change everything up, right? Change their office space, change the way things look, do a lot of interior improvements, right? Several years ago, when there was a lot of tax law changes, what are called qualified improvement property, right, were depreciated very slowly. However, in recent years, that has been corrected to now say, hey, these improvements and all can be depreciated much faster, right? So again, keeping good records of improvements and so forth that you made, but also looking back and saying, hey, maybe what we capitalized just a couple of years ago that we had to depreciate very slowly, we may be able to write off today.
Right.
There's a few forms and a few things you have to jump through with the IRS, few disclosures you have to make around that. But basically, it's taking a hard look that even just from a couple of years ago, look at your asset listings, look at the assets you placed in service that you had to capitalize in those years. And if they meet this definition of qualified improvement property, again, most of that's interior renovations and such, it probably qualifies to be depreciated on a much quicker basis. Again, speeding up your deductions into today.
Yeah. So if I own like a retail center and one of my tenants comes in and they don't really do any modifications at all to the shell or the core of the building, all of that interior, build out, even interior walls and, flooring and anything else, that all qualifies under this qualified improvement property. And then the depreciation, like you said, is now 15 years and it qualifies for bonus depreciation, which currently would be 100%. So you could have a very significant cost basically written off in year one, given that it's under these rules for the qualified improvement property.
And I'll take it one step further. I know that we have several clients we've spoken on our previous segments about cost seg studies and things such as that. Go back and review your cost seg study reports, things like that where these kind of things are disclosed. That says, hey, some of these may qualify if the laws are changed. Well, guess what? Now they've been changed. And so just, again, taking a harder look at those assets to see if any of those would qualify. And if so, what kind of benefit you could speed up to today and what additional depreciation you could probably take today.
Yeah, and you've had that happen where in the last few years, 2018, 2019, you had qualified improvement property that, now that the rules have been updated and changed, in 2020, you were able to go back and take all those deductions, which I think is very favorable.
Definitely.
Well, that's all the time we have today, but we're going to continue this series and do another video continuing kind of our discussion between tax planning on real estate operations. So hope you can join us. Thanks, guys.
Thanks.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.